Well, those are the headlines that we are tracking for you this evening on ET Now, so stay tuned. Well, let's bring on board our guest for today then. Joining me on the show is George Mitra, co-founder and CEO of Finto, to talk about how you can deploy your money in markets that go beyond India. George, thank you so much for joining us today on the show, and I hope you, your team at Finto and your family are keeping safe amidst this pandemic. So George, to start with, this is an area of investing that a lot of us Indians tend to ignore. We think that, okay, when it comes to choosing an investment instrument, I have these X number of, investment categories that I have to invest in. And, beyond that, it's sort of almost like a dark sea, which really you can't look beyond. So, why do you think it's important? Do you think, in fact, it's important for retail investors to look at investment options beyond India?
Thanks, Mubina, for your wishes, and I'm wishing all of you also safe. Very important question, actually, Mubina, you asked, and it's not about retail or high net worth individuals. Everyone, while we are saving, we need to optimize on both our risk as well as return. So diversification is all about, taking away the risk from the domestic risk, whatever we are facing in India. But what about the opportunities? We are all living in a globalized world. So when it comes to investing, why be limited to the opportunities which are there in India only? So diversification is all about, getting some pockets of your money in markets which will give returns at different points of time. And by moving out geographically, it actually helps diversify Indian risk, but also gives you the opportunities across the world.
Okay, so it helps you diversify any country-specific risk, or in our case, any India risks. So, how does one go about that investing in foreign markets? What are the tools available back home to be able to do that?
India has actually allowed us to remit money, that means send money outside India, under something called the liberalized remittance scheme. Under that, up to $250,000, each of us are allowed to send across outside India every year. This route has been used for things like education, for medical reasons, or for investments. So far, most of the time, the ultra HNI, the high net worth individuals, were the ones who were using this opportunity to diversify as well as invest into opportunities out of India. Now, under the same route, we can have everyone invest, and the new age fintech, including like what we are doing, allows you to send as small as sums of money as $1,000 maybe to remit and invest into anything outside India. So that's the same thing. The route is the liberalized remittance scheme. It's been around for many years. It's just that the opportunity for smaller investors to invest properly was not there before this.
Okay, so in fact now I guess there are more opportunities and windows as well available for ease of investments by Indians, retail investors into markets abroad. Now, what would be the best channel, George, in term, and I ask you this question, keeping in mind that the retail investor may not have the expertise to invest, directly in markets abroad. As it is, they may have a limited knowledge when it comes to investing back home. So then to sit and understand a market abroad, which obviously will be different in many ways than a market back home, what would be the best channel then in such a situation for a retail investor to adopt? Because you would like an investment route that provides you with some knowledge as well, some hand holding as well when you do opt to invest abroad.
A very good point, Mubina. I fully agree with you in terms of what you are recommending. And it's right. We should never invest into one single thing. And all investors should create a basket or maybe invest in ETFs rather than any individual stocks. The good point is that, like, when you're investing in the US, you have something called a fractional share, which actually allows you to have a diversified basket for very small sums of money. So you don't have to buy one share of Google or one share of Tesla. you can buy 0.001 share of Apple or Google. So that's the smaller amounts which you can do, which actually helps you diversify. But I couldn't agree with you more. Before investing, it's always good to understand the market. Using advisors or fund managers who are out there would always be better than trying to do something on your own for the first time. And there is a lot of opportunities out there to invest into these baskets. So, for example, we got an ex-Wall Street banker to help us in terms of creating and curating baskets. So there would be these baskets or fund managers which you can access directly by using this LRS route rather than having to do everything on your own.
Okay. So, I'm glad you brought up this whole thing of investing in Tesla and Apple, etc. And, of course, you can do so fractionally as well. However, there's yet another way of investing abroad that I'd like to talk to you about, and that is these foreign-oriented funds. A lot of mutual funds back home itself do the job for you, the same job that they do when it comes to investing in Indian stocks. They take your money and then they spread it across in different stocks. You just have to buy a unit of the fund that has, its money put across in all these different stocks. What would you recommend a retail investor? Investing directly in Tesla, Apple, Microsoft, etc., or investing perhaps in one of these foreign-oriented funds?
So, Mubina, what I'm saying is that we definitely should put money behind an advisor or a fund manager who has a basket of stocks. One of the ways which you mentioned is something called a feeder fund route, where you can invest in Indian rupees into mutual funds in India, which are investing offshore, which is in any of the foreign markets, into certain themes which they have curated. So as far as we know, there might be about 6 or 10 of these feeder funds which are available in India. Using the LRS route, which is sending money outside India, instead of the 6 opportunities, you probably have 10,000 opportunities, because you can invest into any of the funds outside India also. So when I'm saying that Tesla and Apple and things like that, you may be having fund managers who are managing FANG stocks, or you may be having fund managers who are looking at innovative baskets. So you have a larger variety of options available if you send money and invest into funds outside, compared to the funds which are available in India, but both of the routes are available.
So, would it make sense then a little bit in foreign funds, a little bit in stocks, and also if you could talk to us about maybe the disadvantages as well when you are putting it in funds? Because, if I look at some of the foreign-oriented funds we have from back home, we have the US Equity Opportunities Fund by Nippon, we have a Global Equity Opportunities Fund by PGI, then there's a US Blue Chip Fund as well by a whole host of mutual fund houses. What I notice is that a lot of them are oriented towards the United States. Firstly, would you recommend venturing beyond those commonly known markets which a lot of these funds as well have foreign oriented funds for?
So, Mubina, if you look at the really large funds outside India, you're looking at the indices, for example, the global indices would have about 50 to 55% anywhere in the US. It's beyond that you would have something non-US. The reason being is US happens to be the largest market. Most of the stocks which you can think of, most of the brands are actually listed in the US. So having a large US portfolio as part of it is anyway the first step to take. Like if I'm getting into India for the first time, into a domestic Indian equity, I'd probably go in for large cap stocks. If I'm going in for large cap stocks worldwide, that by its very nature would have US as the main proponent. Now, once you diversify and you actually start building up your offshore portfolio, then you may want to take a little bit of thematic bets, like, you have Europe, or maybe instead of having country specific, you may want to have, let's say, commodities. So themes and all that can come as a second step. But the first step is actually building out a core portfolio, which is large cap oriented, which by its very nature happens to be US. You can either do it through these funds, which are into large caps, or build up your own baskets of these large caps. but it will be US by its very nature.
Okay, all right. Now, let's talk about the suitability of foreign investing as well. We have a lot of individuals, I mean, some of them are young, they come out and we get questions as well from them saying that, I want to invest my money in risky assets, I have time on my side, and, I want multi-baggers, etc. I mean, who wouldn't want them, right? But then, of course, we have some individuals who email us saying that they are very, very cautious. In fact, they would like to stick to fixed deposits and the more commonly known investment instruments, the one which are more in the safer territory and where you have the return written in black and white. Who is global investing for then? For which category of these investors?
So first and foremost, if it's fixed income, which is what we are talking about for really, really conservative investors, then you have to see the interest rate in any country. And if you compare Indian interest rate with the US interest rate, obviously Indian interest rates are higher. So for a person who actually only wants a fixed income return, it makes no sense to be out of India. Having said that, being conservative doesn't mean that 100 rupees actually goes into fixed income. Because even if you're getting a 5% return and inflation is 6%, every year you're losing money in terms of the purchasing power which you have. So even conservative people have to have some components of their asset allocation into higher risk, which is equities, maybe. So when you look at it that way, that a conservative or an aggressive will have an asset allocation, the percentage of risky assets in each of them will be different. Within that risky asset percentage, having a bit of diversification out of the country, not only from the risk perspective, but on terms of multi-baggers, so to say, can also be done from an offshore perspective. So Mubina is for everyone, except for those people who believe fixed income is the only way, and they're happy to live with inflation eating up with their returns.
So George, out of my allocation to the risky assets as we call it, how much is advisable to be put in foreign oriented stocks, funds, etc.?
Even like when we were doing the full modeling for offshore, onshore and all that, the offshore asset, even for an aggressive guy, is around maximum 15%. And for a very conservative guy, out of 100 rupees, would be about 5%. So it's not out of their risky portfolio, but overall portfolio, between 5 and 15% is a good allocation to have for offshore.
And 15% is a good allocation of your overall portfolio that you could put in foreign stocks, foreign funds, etc. All right. Okay. Well, you know what? I think at this point of time, I'd like to open the floor for our viewers' questions and queries as well. Ladies and gentlemen, if you have any questions that you would like to ask, George, on investing abroad, investing in the US or wherever, you can email us. Our email address is themoneyshow@etnow.tv. Well, for now, we'll take on board some questions that have already come in. We have a very interesting question, which we've actually not, taken on board in our discussion, George, and this is with respect to the whole currency angle. Farhan Asghari asks us, is it the right time to convert rupee into dollar and invest, or for some time? The rupee actually has been falling quite a bit against the US dollar. The last time I checked, it was at least more than 75. It had crossed that 75 mark. So if I have to convert now, it may turn out to be a little more expensive, but really, should that be a point of consideration when I'm making that decision, to move to, investing abroad?
Mubina, just to take a little bit time back, till about 3 weeks back, India rupee was actually one of the best performing currency in the world. Okay, and then now it's over the last 2-3 weeks, it's fallen drastically in terms of that. So first, currency is extremely volatile. That's one. Number two, as an investor, we're looking at a slightly longer period of time, not on a day-to-day or week-to-week. When you look at it that way, rupee actually depreciates on an average about 3 to 4% vis-a-vis dollar. Now, trying to time this volatility is not something which we would like to do. So just like you do in India, you go through SIPs and you do an averaging in, even offshore, you can do it in small bits. So for example, you can, like what we are allowing people to do is in bits of $250 to actually start investing so that they average out the currency exchange. Having said that, you're going outside for more opportunities, and that opportunity is probably a much wider range than the rupee dollar conversion. So first, it doesn't matter so much, but having said that, given the volatility, best to average in rather than doing it at one go.
So almost like an SIP method that we use, right?
Absolutely.
When we invest in Indian mutual funds as well. That's what you should consider doing. That's what you should consider doing even abroad. Okay.
And the fintechs allow you to do that.
A question from Bala, something similar. Where is... Okay, great. All right. So Bala asks, where in the USA should one invest? Most are familiar only with the big IT stocks like Microsoft, etc. So again, a question that, George, a similar one that I asked you as well. So yeah, if someone has to start off with, where would you recommend they start off?
Just want to tell Bala that Microsoft is not the only company we know. We know companies as varied as Pepsi, Coca-Cola, to Google, to Pfizer now. So in our everyday life, we actually know all these brands. And guess what? They're all actually listed in the US. So there is a whole basket of them, whole plethora of opportunities. What I would recommend first is figure out what is the theme which we want to pick out. So for example, we want to do innovative technologies because we know US and the world has got a lot of innovation which is going on. Then maybe pick out a basket of ETFs which are into innovation. In the US, the opportunities in the listed space is so wide. So for example, work from home. That's an ETF which has been created in the US because the opportunity is out there. So if we sit down with our advisor or if we sit down and do a planning, that what is the next 2 years, 3 years, 5 years, what I think would be a theme. Within that theme, you can pick up almost any brand which you know of because you'll be familiar with that. We are all globalized. We use all these brands. It's just that it's not listed in India. It's listed outside India. So my thing would be just create a theme, what you feel like. Innovation seems to be one of the main themes which one should be looking at to be investing. And as I said, may not go after the stocks directly if you do not want it, but there are many, many ETFs which are there which you could invest into.
Okay, well, I think we have time for one more question then. We have Siddhant writing in, and I think we've largely answered his question, but he asks, is it advisable to diversify portfolio with offshore mutual funds for the long term? What percentage of the portfolio? So I'll give that answer for you, Siddhant. Yes, it is advisable. And like George said just in the last answer, that you put 5 to 15% of your overall portfolio in this. But here's a very interesting addition to his question. He says, do you recommend would it be ideal to invest in one offshore mutual fund scheme or more for better diversification? In fact, he's also given his list of 5 funds: Nippon India US Equity, PGM India Global, Edelweiss Greater China Offshore, ICICI Prudential US Blue Chip, and DSP World Mining Fund. Any advice on the above mentioned funds would be appreciated. So yeah, what's your take on that? 1 fund, 2 funds, how many foreign funds? And yeah, if you have a comment on any of the funds that I just spoke about.
Mubina, I think at least 2 funds should be chosen. Maybe you could choose one of these funds from a large cap oriented basis. But see, whenever you're going in for a theme, whether it's a mining perspective or geography specific like the Greater China, you have to have a lot of conviction for you to be able to do that. So as a first time investor, I would rather you invest into diversified large cap foreign funds. The list which you have given are limited in nature. As I said, maybe 1 feeder fund, which is through Indian rupees, and 1 offshore fund through a dollar rupee. You can actually easily choose for building out your portfolio. But initially, would not recommend a theme-based fund.
I think that's all about investing in some of those offshore funds as well. But with that, we are out of time. We're not going to be able to take any more questions. George, thank you so much for joining us today on The Money Show and helping our viewers out with this topic on investing abroad. Well, with that, folks, we'll take a short break as well. Be right back with more on ET Now.